everybody, Chris here from projectoption.com, and in today's video we're going to talk about how to make money by selling strangles. So if you're familiar with the short strangle strategy, you'll know that it consists of selling an out-of-the-money call and an out-of-the-money put on a stock, and the strategy profits when the stock price remains between the strike prices of those options or when implied volatility or option prices decrease. So in today's video, we're actually going to look at two different short strangle management approaches, and we're going to see which one performs better. Alright, so selling strangles, taking profits versus taking losses. So when it comes to selling options, many new traders focus on the profit-taking side of the equation and don't really think about the loss potential. Now this is natural because when you sell options, you're going to have a lot of frequent winners that are small, but eventually you're going to have a losing trade, and those losing trades can potentially be very large. Now, this begs the question, when selling options, is it more important to take profits early or to focus on keeping losses manageable? So when you sell options, you're going to have a lot of frequent winners that are small, but your losses can be devastating, although infrequent. So to answer this question, we ran a 10-year strangle selling study with two completely separate trade management approaches for the short strangles. Now the first trade management approach was to only exit trades if a predetermined profit target was reached. Otherwise, the trade was held to expiration. The second management approach was to only exit trades if a predetermined loss limit is reached. So in the first approach, we're only concerned with taking profits, and in the second approach, we're only concerned with taking losses. So let's go ahead and look at the details of how we set up this study. Alright, so here is the study methodology we used to perform our profits versus losses test. So the underlying we used is the S&P 500 ETF, which has the ticker symbol SPY. For our trade entry dates, we use the first trading day of each month, starting in January of 2007 and ending in early 2017. Now the expiration cycles we used were the standard expiration cycles in the following month, which means the expiration cycles had 43 to 52 days to expiration. Now the trade we placed on the trade entry dates was a short strangle with 16 delta calls and 16 delta puts. So that means we're selling a call with a delta near 0.16 or 16, and we're selling a put with a delta near 0.16 or 16. This creates what is called a one standard deviation strangle, or a strangle with an approximate 68% probability of expiring worthless. So with these trades, we followed two separate management approaches and compared the two. So the first management approach was to close profitable strangles for 50% of the maximum profit potential. So if we sold a strangle for $1, we aim to buy it back for 50 cents because the maximum profit potential is $1. So we're looking to close the trade for 50 cents, which means $1 minus 50 cents gives us a closing price of 50 cents. Now the second management approach we tested was to close unprofitable strangles for negative 100% of the maximum profit potential. Now this means if we sold a strangle for $2, we closed the strangles when the loss was $2 per strangle. Now, if you sell a strangle for $2, the loss will be $2 when the strangle's price reaches $4. Because if you sell it for $2 and it reaches $4, if you buy it back for $4, you lock in a $2 loss. So let's go ahead and see which of these management strategies yielded the greatest return over the 10-year period. Alright, so in this graph we are looking at the cumulative profit and loss of the two approaches. So the dark line is the profit-taking approach, or closing strangles of 50% of the maximum profit potential, otherwise they were held to expiration. And the green line is the loss-taking approach, which is closing losing strangles for a loss equal to the maximum profit potential, or letting the trades run to expiration. Now when you compare the actual equity curves or profit and loss curves of these two strategies, we can see that after 2008, the profit-taking approach had a very, very smooth and upward sloping trajectory. Now, if you compare that to the loss-taking approach, we can see a little bit more chop in the loss-taking approach. However, the loss-taking approach yielded a net profit of around $6,100 over time, and the profit-taking approach only yielded around $3,500 of profit over that same time period. Now, the major difference is in 2008. As we can see, the profit-taking only approach in 2008 lost substantial value. So before that market crash, the strategy was up around $1,500 cumulatively, and after the market crash, the strategy was down almost $3,000. So that's around a $4,500 loss just by taking profits only and letting losers run to expiration. Now, when you look at the loss-taking approach, we can see that the strategy did have a slight hiccup in 2008, but the losses were very, very manageable, and the strategy as a whole only lost about $750 compared to the $4,500 loss of the profit-only strategy. So, as we can see here, just avoiding that one massive drawdown significantly added to the bottom line over time. So this stresses the importance that when you're selling options, especially naked options without any protection, the key to profitability is keeping your losses small. Now, while only taking profits and letting your losers run to expiration can be profitable over time as well, you never know how large the next market correction is going to be, and therefore you need to take hold of the one thing that is unknown when selling options, which is how much you can lose. So now let's go ahead and look at the numbers related to each of these strategies. Alright, so let's start with the success rate for each strategy. So taking profits early and letting losers run to expiration had a success rate of 89%. That means 89% of the trades were profitable. Now when we compare that to the loss-taking approach, we can see that letting winners run and only taking losses led to a success rate of 71%. So only taking losses as opposed to only taking profits had a success rate that was 18% lower than only taking profits. However, if we look at the profitability metrics related to each trade, we can see that the loss-taking approach had significantly higher average and median profits per trade, and the biggest loss was substantially lower than taking profits only and letting losers run until expiration. So looking at success rate only does not tell you the whole picture, as you need to know how big the winners and losers are. So in this case, even though the loss-taking approach had a 71% success rate compared to an 89% success rate, the strategy was twice as profitable and had a biggest loss that was significantly lower than the approach that only focused on taking profits and did not worry about losses. Alright, so let's quickly recap what you've learned in this video. So first and foremost, many traders focus on the profit side of the equation, though focusing on keeping losses small is the key to profitability, and it's especially true when selling options. When selling 16 Delta Strangles in the S&P 500 over the past 10 years, closing losing trades early significantly outperformed closing profitable trades early. That's because by keeping losses small, you keep more of the profits when you're right. Now, though the loss-taking approach to selling Strangles had an 18% lower success rate, the strategy made up for it by keeping the losses small, and we can see that by the minimum drawdown being 80% lower than simply taking profits and holding losing trades to expiration. And finally, when implementing an option selling strategy with significant loss potential, profits will typically be small and frequent, but the infrequent losses can be substantial, as we've seen in the previous graphic. Now, if there's one thing that you take away from this video, it's that avoiding catastrophic drawdowns when selling options is the key to long-term profitability. Nothing else matters. Thank you so much for watching this video, everybody. Please go ahead and take a moment to subscribe to our YouTube channel by clicking on that circle on the left-hand side. If you want to check out some more videos, click on that video link on the right-hand side. And finally, please go to projectoption.com and sign up with us so you can get all of our amazing content as it comes out.